Thank you, Professor C. Veeramani, Director, Center for Development Studies, for giving a macro and micro analysis of the subject and also touching upon GVC's importance of the GVCs and the need of the country currently moving from the transition stage of service economy to the manufacturing sector. And he also brought about the various important aspects that is on a totally different angle altogether. Thank you, sir, for being and for a wonderful presentation. I know we don't have sufficient time to hear more about your details, of course, during the Q&A we'll have more clarity. Now, as per the program, we have the next speaker is actually supposed to be from the Sony Mathews from the investment angle, and the investment angle is very much important. But since with the permission of Sony, I think we have Priya Narayanan from Direct Taxes from Delaware. She has to catch a flight to Bangalore, back to Bangalore. With the permission, I'm requesting Priya to take over and do the direct taxes presentation. Of indirect tax, we'll have a subsequent later on after the Sony's presentation. Thank you. And Priya Narayanan is a chartered accountant and partner with Deloitte, and she has 22 years of experience in direct taxes, and she handles the Kerala market for Deloitte.
Thank you, Mr. Savio, and thank you everybody for making your time here today evening. So, today I will be covering the direct tax proposals presented by the Finance Minister in her speech yesterday. I will also be accompanied by my colleague Kezia, who works in our tax practice in Cochin office. So, I apologize, I have to take a flight back and it's going to take a good time to reach back home tonight. So I have requested Kezia to stay back, and if there are any clarifications, we are happy to, address those. Either you can drop in a mail, talk to her, you can call us. More than happy to take that up. Now, just to set the context over here, and right before me, we heard Professor Veeramani talk about, this being a budget where there was a lot of rationalization, and I tend to agree because over the last 8-10 years, I think the biggest demand from the corporate sector has been to provide clarity in taxes, to provide certainty in taxes. We don't want surprise amendments, we don't want retrospective amendments, and that's the way the Western world also works. Because, the amendments are not really typically announced in a conservative, traditional format of budget, and, people debate over it, and it becomes an annual event of sorts. So we want to move into a regime that, it's largely, stable, clear, and corporations can take actions according to what is written out. Having said that, I think if you observed in the 90s, we had to open up the economy, and there was a lot of companies that came in to set up their presence here. And at that time, we had even favorable treaties being entered into, whether it was Mauritius, whether it was amendments that were carried out in some of these countries where we get investments, significant FDI inflows from. Subsequently, in the years 2000s and up to about 2017-18, we had, for the services sector, we had the STPI, we had the SEZ incentive, which enhanced our service potential and capability in India. 2020 onwards, the government has made a very conscious move to say that, the incentives that we roll out will be limited, but we will bring down the headline corporate tax rate. Therefore, from having a headline corporate tax rate of 30%, which effectively meant about 33 to 34% for corporate, it was brought down to 25%. So assuming that companies or, businesses are not claiming any additional incentives, then the tax rate today is only about 25%. This therefore means that you don't go claim incentives to bring the ETR down, but you also have stability in what you're claiming. We have one extra incentive, of course, that is in line with the policy of, having to promote Make in India, and also move up the value chain when you make in India, as Professor Veeramani pointed out that, maybe assembly is an entry point, but, you start moving up the value chain. And I can tell you that, it's similar for services that, when you start off, maybe you start off as a knowledge processing center, you start off as a center where, you can do some back-end activities, but eventually we have seen the services sector also move up the value chain to say, I can now provide R&D activities, maybe I can provide some technological enhancements to my global offices. Therefore, having said that, the impetus that was provided was in 2020, we did see some bit of shift to Make in India campaign, and therefore we had the 17% tax rate come in for companies that were set up within a specified period, that is up until March 24, and starting production of a new line of a facility, new factory without, reconstituting something that was already in place, one could claim 17% tax rate, so further lowering from 25 to 17. We may not see any rate below 15% because of the global understanding between big countries that the headline tax rate should not go below 15%. So that's the best that we could land in. The only expectation around that was probably this manufacturing incentive needed extension, but I think we have seen a sunset earlier this year in the interim budget, and that has not been extended, but that's where we stand as far as incentives are concerned. On another point, I would also like to highlight that probably, R&D incentives was something that Deloitte also came out with a report recently, and we were hopeful that there will be some encouragement for R&D activities in India, because many of these, organizations, as we mentioned, that have started doing significant value improvements in the process. So, typically the earlier 35(2)(ab) regime only allowed R&D if it was in-house, housed in India, whereas if I'm doing R&D for my global office, I may not qualify for an extra incentive. So that was one thing probably, has been an ask both from the tech sector as well as from the biosciences and pharma sector to have some R&D related, incentive. I'll just move forward with, we have divided this into three broad categories. We have individual tax, we have some bit on capital markets M&A, and we have corporate tax. So I will start off with, the individual tax related presentation, because I think that pinches the pocket the most. So with regard to individual taxes, I think the first amendment is that we have a new slab rate that has come in for new tax regime. The idea again for individuals is let's not have multiple deductions, multiple incentives and exemptions rolled out, but we move to this new tax regime, which is fairly simple. You know the rates and you compute taxes and you pay. So therefore, the standard deduction has, undergone a small change, as well as, there has been, the slab rate has undergone a small change, as well as the standard deduction has moved up from 50,000 to 75,000. So these are the, new amendments that have impacted the individuals. The net effect is about 17,500 rupees. Apart from that, I think a couple of other small changes that have come in is in order to enhance employment and enhance employment related incentives. We have a new employment linked incentive scheme for Provident Fund that, employers can claim, and there will be funding to some extent. There is a scheme A, B, C, and more details in the policy, but this is in order to encourage employment. The next thing that I just thought I will cover in individual taxes is the rates that are proposed. So up to 3 lakh, the current regime on the simplified till last year, FY 23-24, the tax rate was nil. It's the same. It continues to be nil for FY 24-25. The second bucket, which is the 3 lakhs and the 6 lakhs, is used to be 5%. We continue with the same 5% rate for an income earned between 3 lakhs to 6 lakhs. The next one is where there is a small tinkering. For the bracket of 6 to 7 lakhs, we had 10% rate. It has moved to 5%. And, the advantage is that we are looking at a simplified structure. So we don't want too many slabs coming in. We rather want to have minimal slabs. And I think it is with that convergence idea that we have brought this down also to 5% to move it to the earlier bucket. I wouldn't be surprised eventually even if the 7 to 9 goes away and moves either way. So either the 5 converges with 10 or the 10 converges with 5. The only other amendment in the slab rate is when the income is 9 lakhs to 10 lakhs, then the slab rate used to be 15%. It has come down to 10%. Having said that, I think, one of the things as salaried employees, we can also be mindful is that when there is a salary income, the TDS that the employer withholds is typically, the employer will be able to give only credit for withholding taxes. But going forward, there is one amendment which allows credit even for tax collected at source. So as individuals, when you travel overseas, when you have certain kind of expenditure in foreign currency, or when you buy a car, typically you are subject to something called as TCS. That TCS was not creditable against the salary TDS that was there, and they used to still deduct higher TDS. Now with that credit coming into my salary income, I can tell my employer that, I already have TCS credit of X, therefore, limit my TDS credit only to X, the amount minus X. So to that extent, the refunds can also come down for individuals so that there's no dependency on the refund coming back after the return is filed. Let's just take I know the font is a little small for maybe people sitting at the back, but, we have just tabulated what could be a potential tax impact for a person earning 7 lakh salary, for a person earning 20 lakh salary, for a person earning 35 lakhs, and for a person earning 55 lakhs. Now, at the 7 lakhs salary levels, there is no change because you get the standard deduction, and the slab rate that is there is not significant. But however, when it comes to the next two buckets, you will have a saving of 17,500. The workings are there in detail. We can of course share the slides, but I will move on to the next section, which is I'll come back to the corporate tax section, but I will move on to the M&A section first and then come back here. But up until now, are we okay? Do you need any clarifications, or we go for it in the end? Okay. So when it comes to the measures with regard to M&A, I think the key principle that we have looked at to recognize that the government has to recognize that there are some inherent challenges in sustaining overseas interest in our investment. Today the markets are doing well, and you have probably a lot of investments coming in from overseas and people wanting to list in India, because that's a big trend we are seeing even with startups, even with companies that are incorporated in India. That earlier there was a big push to go outside and list. So they would have an overseas holdco which would get listed in Singapore or US. But that has changed significantly. Today you see everybody wanting to internalize, which means that bring the structure back into India and list from India. So that is one aspect that we are seeing a significant change. Apart from that, I think as the corporates also want, they want a simple tax regime which is easy, and therefore the capital gains amendment has come in with just broadly 2 levels of tax rates. Yes, short term has an additional level of rate, but otherwise there's just 2 rates that you broadly have. And the other aspect was also bringing money into India. Earlier meant that there could be something called as angel tax that has got abolished. I'll get into some level of details for each of them so that I can explain this better. Yeah, so what is it in capital gains? Now in capital gains, I think the first thing is that we have broadly 2 buckets. We don't have multiple rates, multiple buckets going on. The first bucket is in case of listed security, 12 months to continue, 24 months for other assets. Now when it comes to the rate, what has happened is for long term, we used to have 2 rates earlier. We used to have a 10% rate for listed securities, and we used to have a 20% rate for certain other asset classes. Now what has happened is, if you have a listed security that is hold, the rate has gone up from 10 to 12.5%. So there's an increase in rate over here by 2.5%. Whereas for all other, for many of the other asset classes, we used to have a 20% rate. That 20% has been brought down to 12.5. So for long term, there is just one uniform rate now of 12.5. 10 moved to 12.5 and 20 came to 12.5. So this is the rate that we use for capital gains. As far as short-term capital gains is concerned, perhaps they believe that like long-term, this is the right time to collect some extra taxes. Therefore, instead of 10, it moved to 12.5. So short-term has moved from 15 to 20. And, the listed security going forward will be taxed at 20% if it's short-term instead of 15%. I might also mention over here that the reduction in long-term capital gains of 20 to 12.5 also means indexation benefits are taken away. And this is a critical amendment because for most of us who have probably real estate property, earlier the sale of a real estate property was entitled to an indexation to adjust the cost of inflation. So you get a step up in the cost base or the cost value that you offer for tax. However, going forward, that has been taken away. So therefore, the 20 coming down to 12.5 may seem very good, but it comes with the rider that the indexation benefit has been taken away. I think the next amendment, I think on buyback taxes, we have had a lot of flip-flop. So, earlier, buyback was treated as a transfer of capital asset, and therefore any income generated by the company doing a buyback of share was subject to a capital gains tax in India, which meant that in case you had an investment from an overseas country where you had a beneficial DTAA, typically Mauritius and Singapore of sorts, then you could claim the exemption. So, companies could easily do a cash repatriation using that buyback option. In order to plug that, about 10 years ago, they said that buyback would be taxable as additional income tax, which means it's like a dividend, not really a dividend. It's paid by the company, not covered under DTA, therefore the overseas company may not be eligible for credit, but you get a cost deduction for the amount that was originally invested. So if you buy back shares at 100, the original investment was 10, then 90 was what was subject to a 22% buyback tax. However, first it came for unlisted, then it also got extended to listed, and then today there has been an ask from the industry, because this can pinch the pocket very heavily for companies that are distributing, to equate it with dividend. Therefore, there are a couple of proposals to equate this with dividend, and therefore it will be going forward taxable as dividend. There are some anomalies in the amendment here. Ideally, it should have also come through a dividend related section that has not come in. I'm assuming that before the finance bill final version is out, that will be taken care. Now on angel tax, and I think this is a very critical section. So there is a section called 56 subsection 2 subclause 7D. The intention was that if a company raises excess capital in over and above its fair market value, then that was subject to tax in the hands of the company that was receiving as income from other sources. So you have face value 10, fair market value 25, and assuming your investor invested at 35, then the excess 10 would be typically taxed as income from other sources in the hands of the person receiving the money, which is the person issuing the shares here. However, this was actually becoming an impediment in raising capital for startups. When it was introduced 10 to 12 years ago, the context was not in the context of startups. But today what happens if a startup has a fair market value of 25 and an investor is ready to invest at 35, then the whole issue was that it could get taxed. So in order to abolish that and ensure that more capital can come into the market, this has been abolished, the so-called angel tax. I think I'll just move over. I think, yes, there are some changes in STT for futures and options, perhaps increased rates so that, it is not very lucrative to invest in them anymore, but that is one of them. And I think also the other part that we need to look at is the part relating to corporate gifts. When a corporate entity used to give gift earlier, there was always a doubt whether a company can gift any asset to another company or individual, because generally gift is given only with the connotation that there is love and affection. However, there are high court rulings saying that there is no emotion that has attached to a company, and therefore companies cannot gift. In the Western world, this is typically known as contribution. They don't call it as gift, they call it as contribution. Now, what's happening now is that because of these High Court amendments, they have said that gift is not permissible by corporate, or rather it's not tax exempt by corporate. I'm not saying it's not permissible, I'm just saying that it's not tax exempt anymore. The gift provisions are now restricted only to individuals and HUFs, which means that only these type of persons are allowed to gift, because the underlying principle as laid down by High Courts is that there should be love and affection when you gift the property. The other aspect I just thought I'll mention is the procedural changes around reassessment, because reassessment has been something in the last 4-5 years we have seen a flurry of notices affecting many taxpayers. So reassessment timeline has been brought down. And another important one is the IFSC. I think we've been seeing that the government has tried to promote the IFSC for the last few years, because they want to draw in investments. I have been to the IFSC a few months ago, and I can tell you that the GIFT City is very well developed, but I think they need more investment there, and therefore, in order to promote, they have removed some of the other regular provisions that could have applied to companies that if you're set up in IFSC, that may not apply. Having said that, I think we are yet to cover the corporate tax provision. Just going back to the corporate tax provision, while Kezia will cover it, I will just give an overview. Now, as far as corporate tax provision is concerned, I think a couple of amendments, which is in relation to foreign company, Professor Veeramani alluded to earlier. When there is a foreign company who has a presence in India, it could be a branch, it could be a permanent establishment. In those cases, the rate is reduced from 40 to 35. It is not as if a wholly owned subsidiary of a foreign entity in India will be subject to a lower rate of tax. It's only if you're incorporated in India as a company, the rate still remains same, either a 25 or 30% bracket as you choose. But for a PE or a branch of sorts, then the tax rate drops from 40 to 35%. Another important amendment was around the equalization levy, that when you have the platform that's available for overseas companies to come and invest or sell and trade into something called as equalization levy, that has been done away with. Apart from that, I think one big area that I just touch upon and then hand it over to Kezia is around the measures around Vivad Se Vishwas scheme. Now, in industry, we have seen that there have been amnesty schemes provided by the government many times in the past, whereas that was an ask for direct tax. In 2020, we saw the first VSV scheme come in, and primarily the purpose was to clean up litigation. But today what we see is that the litigation has again piled up. While some companies went in and opted for cleaning up of litigation, that pile up has again come back today. And the pile up is the highest at the CIT appeals level because there aren't enough CIT appeals to dispose of. So we are seeing long pendency in CIT appeals, whereas ITAT is a little more faster and clearing in 4-5 months. Sometimes you get an order, whereas CIT appeals, we have cases for 3-5 years not still disposed, not heard yet. So in order to ease the workload at the CIT appeals level, the government has come out with another scheme called as the VSV scheme, and where the companies can go and opt in to ensure that you can, to reduce your number of litigation that is open. Because this is a common ask, especially in foreign companies context when they set up in India. Many of them say that the litigation is very long drawn. You have cases of 10 years, 12 years, 15 years open. And when do you see the light, light at the end of the tunnel? So this ask is something to address that, if we can reduce the number of. Apart from that, we've had reduction in TDS rates. Over to Kezia. She will help us walk through these provisions. Thank you.
Just to introduce, my name is Kezia and I work with Deloitte Cochin. I work as a manager and I specialize in direct taxes. So moving to the slide. Yeah, so Priya has already covered about the tax rates being reduced for the foreign companies from 40% to 35% and equalization levy being abolished. While it has always been on top of the government's mind to reduce litigation, and Vivad Se Vishwas has been one such scheme, again reintroduced in 2024 after being introduced in 2020. There has also been monetary limits which have been increased for filing appeals with the ITAT, High Court and Supreme Courts. Earlier it was about 50 lakhs, 1 crore and 2 crores, the monetary limits for the 3 courts respectively. But now the limit has been increased to 60 lakhs, 2 crores and 5 crores in case a company has increased tax demand post-litigation. Going forward, as of now, as you know, the assessments and the appeal process from the first appellate level, which is the CIT, has been mostly digitized and it's online mostly. While the rectification and order giving effect, it is mostly being done by the assessing officers on paper at the tax office. So in order to prioritize and move over to digitization, on an overall front, the rectification and order giving effects going forward should also be digitized in the next 2 years. Moving over to the TDS rates being rationalized, which was already covered by the speakers before. Some of the rates which were at 5% has been reduced to 2%, which was mainly in case of payment of insurance commission, payment in respect to life insurance policies, commissions, in case of payments being made by certain individuals to HUFs, so these are the rates which were at 5% earlier, which has been reduced to 2% to ensure that there is more money in the hands of, or the working capital in the hands of individuals and companies are not being affected. Again, payment of certain sum by e-commerce operators to e-commerce participants has been reduced from 1% to 0.1%. So this has been an ask from the industry because a lot of money was being stuck in working capital, which is in the hands of the government as TDS. So I think this should bring about some changes, and this will increase the working capital available to the companies. Another important change is that in case of payments on account of repurchase of mutual fund units and UTI units, there was a TDS of 20%, which has now been removed. So there is no TDS on that. A few other TDS amendments. As Priya has already mentioned, earlier only TDS was allowed as a deduction while calculating the TDS to be deducted by employees on payment of salary to employees. But now TCS also should be considered, which means, for example, an employee purchases a car and TCS is being deducted from the employee. While the employer deducts TDS, the employer should take into consideration the TCS that has been taken from the hands of the employee. So this would, in a way, reduce the tax burden on the employees. The employee wouldn't have to wait for a refund from the government in case the TDS and TCS is considered. Another change is that the salary, remuneration, interest, bonus or commission paid by a partnership firm to a partner in excess of 20,000 is to be taxed on TDS is to be levied on the same at 10% from April 2025. Another important change is that as of now, if an immovable property is being sold, for example, at 60 lakhs, and there are two sellers who are getting 30 lakhs each. So the provision reads that any sale in excess of 50 lakhs will be subject to TDS at 1%. But if there are two sellers and each are getting 30 lakhs each, it's not in a way covering the 50 lakhs limit. But the government has clarified that even if there are two sellers, it should be clubbed and TDS should be levied on the entire 60 lakhs and not the individual limits. So this is in a way a clarification rather than an amendment. Then TDS has been levied at 10% on interest on floating rate saving bonds and any notified security of the government, the central and the state governments. Another amendment is that foreign tax credit, which is available to a company or an individual, it is now deemed to be an income in the hands of the employee or any entity which is claiming the FTC. So that is a notable change. Earlier, this foreign tax credit was not subject to tax, was not an income. So now it's considered as an income and it will be subject to tax. TDS under 194J, which is fees for technical services and managerial services. If a certain transaction is subject to TDS under section 194J, it has been removed from the purview of section 194C, which is a TDS provision in case of payments made to contractors. So the rate under 194C is a lower rate, 1% or 2%, while the rate under 194J is at 10%. So this is in a way to ensure that TDS is deducted under 194J at a higher percent, and the deductors are not adopting the lower rate under 194C. Another notable change is that TDS, in case collected by a deductee and not paid to the government, there was an interest levied at 1.5%, but in case of TCS, the interest was only 1%. So to make it equivalent to TDS, in case of TCS collected and not submitted or provided to the government, an interest will be levied at 1.5% on the amount not paid to the government. Another notable change is, in case of TDS credit available to a minor, it will be available to the parent offering that income to tax in case of a minor. So this provision is also effective from January 2025, the coming year. And in order to track the purchase of luxury goods by high net worth individuals, TCS has been levied at 1% on purchase of luxury goods exceeding 10 lakhs. So these are the notable TDS and TCS changes. So that is all we have to cover from a direct tax perspective. If you have any questions, probably you can address towards the end of the session.
Thank you, Srimati Priya Narayan, partner Deloitte, for the presentation on the data tax, and also her colleague Cassia also for the presentation. We'll have more clarity on that during the Q&A, and also we'll be sharing the presentation of all the speakers subject to the approval to the participants later on. Since she has to leave, I would request Sri Anjali Kottaran to present a token of memento from on behalf of organizers to Sri Priya. Thank you. We are moving to the next speaker. There's a very interesting scenario on the market analysis. To take to that session, we have Sony Mathews. He is a management specialization in established careers at Bombay Stock Exchange and worked as a senior research analyst in equity research firm in Bombay and joined Geojit in 2009 and currently heading the investment advisory department at Geojit. Over to Sri Sony Mathews for the market and investment analysis.
So a very good evening to all of you. So thank you for this opportunity to talk about the budget and present our views and on how the finance minister performed yesterday. So before going into the actual budget, I just wanted to highlight the expectations, because stock market is all about expectations, right? If you meet the expectations, you're okay. If you don't meet the expectations, then you are down. If you exceed your expectations, then yes, it is going to be very positive. So it's very important that we talk about what we expected. It's not a very equivocal or unanimous decision, but this was what the majority was expecting from the budget as a whole. So, of course, like we heard the speakers before, Professor Veeramani and Priya was also mentioning about, the budget's focus on employment, important. The budget was expected to focus on infrastructure. It was also expected to focus on innovation. So these were the 3 points that the budget was expected to focus on. Plus, we were wondering on how they were going to play the balancing act. Would it give more importance to growth-oriented measures, or would it be more focused on fiscal discipline? Especially since there was not a single party absolute majority, it was a coalition government. Would there be populist measures, especially with elections also coming up in a couple of states in the coming months? Would there be more populist measures in the budget? So those were the what the wondering was all about. Second was, there was expected, there was a consumption boost that would have been given to the rural economy, because if all of you noticed, I think after the COVID, this thing, we basically have what economists called a K-shaped recovery. It was not a V, it was a K-shaped recovery, because we saw the rural economy going down while the urban economy, if you want to call it that started going up. the entry level demand or the entry level goods demand was coming down, while luxury goods, they were doing good. Best case example is regarding two-wheelers. For example, two-wheeler sales, it has not come back to pre-COVID levels, while four-wheelers have performed better. So a focus on rural economy was always expected in the budget. And of course, capital expenditure, the spends, it was expected, people expected more in terms of capex expenditure. So these were the expectations, I would say, if we were to look at it, maybe a pre-budget scenario, these were the main expectations, I would say. So when we look at it, after the budget, when we look at it, I think, the budget has ticked most of the boxes. But of course, there were a couple of small surprises, which would not have a huge impact on the stock market. But more or less, I think the budget would have ticked all of these expectations. Was it, a big bang budget? No, it was not. We would call it, or as Geojit Financial Services, we are neutral in terms of what impact the budget would have on the stock market. One of our analysts even called it as a boring budget. So please don't get me wrong, boring is not a bad thing, in the sense that boring has many annotations, in the sense that, it is what it is kept as it is. Continuity is a good thing. So continuity might be boring for somebody, continuity might be good for some people. So I'm not using boring in a very negative sense. It is just what it is, So sometimes we say that, okay, no news is good news, or no big bang it's good news. So there were a lot of things in the budget that the government insisted on continuing. I mean, what they were carrying from last year, I think they carried on this year. So there were a lot of things that were continuing, and it depends on our point of view also. So in our point of view, if we wanted to see big bang reforms, okay, that could be negative in the eyes of others also. So we need to look at it from the point of view as domestic investors. We need to look at it from the point of view of the foreign investors also. So in that sense, maybe continuity is a good thing in terms of the budget. So it is, so what I am about to say, maybe we might not all agree on it in a sense, but generally, if we talk about it, this was a neutral budget with no big bang reforms. But yes, the important thing was that stability, continuity was given due importance in this budget, and that can be a good thing also. So I'll just focus on the measures, because I think the speakers that were before me, I think they've given enough data about, let's say the macroeconomic impact and also the direct tax impact that was there in the last session. So the overall view on this is that fiscal consolidation, fiscal prudence was given importance, right? More than growth, I think there was a fiscal consolidation or fiscal prudence was given importance in this budget. The vision is, of course, the fiscal deficit is coming down to 4.9%. The plan is to bring it down to 4.5%. A growing economy like India, we need a small amount of fiscal deficit. That is always good for the economy. But the idea to bring it down to 4.5% is very important, because the rating agencies, the sovereign rating agencies, will have a view on this thing. So the procedure or the method to bring down this fiscal deficit to 4.5% is a good thing, because our ratings can increase if they see that, okay, there is a proper roadmap to bring down the fiscal deficit. So sovereign rating agents, maybe 1 year, 2 years back, I think there was a little bit of pressure in the economy when the sovereign rating agencies had downgraded or brought it to neutral. So this fiscal deficit or fiscal discipline can have a positive impact on the sovereign rating agencies, as long as we follow the roadmap. And also in the budget, the focus on the ease of doing business, or ease of complying with regulations, that is also, they are maintaining a little bit of uniformity in terms of that. So that all that means that from an investor that is outside, especially a foreign investor, it could be an FII, FPI, even for FDI also. When they look at it, they see uniformity, they see continuity, they see ease of doing business, and that can bring in more inflows, more foreign money into the stock markets, and that can have a positive impact on the market. So from that angle, when you look at the macroeconomic measures that have been proposed in this budget, or even the lack of big budget, let's say, changes or amendments in the budget, which means that the ease of doing, I'm not saying that we are completely there, but yes, it is a start. This whole budget, I think it is a roadmap to go on to bigger things, and it is a small step, but yes, it is in the right direction, and I think foreign investors will have a positive outlook on that. Of course, many of the measures, I mean, personally, I would say that, it is directed towards India already being a developed economy. Maybe as an economy, we might not be ready for some measures, but it is assuming that India is going to be a developed economy soon, and we are already starting the steps to achieve that. So, as I mentioned, the macroeconomic measures, it has the potential to bring in more foreign investor participation into the stock market. So, as a whole, that is positive for the markets. Again, the measures to improve rural economy, very good measures in the sense that, as we talked about earlier, it was a K-shaped recovery earlier. Rural economy was not doing well. So boost to rural economy, rural spending can improve. The focus on employment, of course, means more disposable income in the hands of many youngsters. Upskilling is also a good thing because it increases the employability of many of India's youth. Agricultural growth and productivity also. So all these measures together, I'm not going to the details because we've already seen what the measures are, but all these measures together, what it simply does is, it can, or it has the possibility to improve rural spending. And that is something that has been missing maybe for the last couple of years, that has been not missing in the sense, it has been not up to the levels expected. So this is basically very positive for the FMCG industry. I would say the industries that are consumer facing or industries that do not have big ticket items. So FMCG, especially these measures, will be good for the FMCG sector and also the allied segments. Okay, even two-wheelers can also benefit from this because that is one sector that can benefit from more rural disposable income. So the measures that the government has come out for boosting rural economy, boosting rural spending, I think it will have a positive impact on many of the allied sectors, especially dealing in the low ticket items, including FMCG, it could be two-wheelers, it could be even these small white goods companies. So companies that have more small white goods to sell, it will have a positive impact on these sectors and stocks. I will not be mentioning specific stocks because there is regulation that I'll have to follow, but offline we can always discuss that. The capex spends, yes, it was a good amount. I think it was in the range of 11.1 lakh crore that was proposed by the finance minister. The thing is that as an amount it is good, but there was no change from the interim budget. So the interim budget amount, the capex spend that was mentioned in the interim budget and what was mentioned in our budget yesterday, there is no change. So even though the amount as such is a good number, even in the third point I've mentioned that the ratio of capex to total expenditure has actually improved to 23%. It was 21% last year. So the ratio of capex also has improved. And a professor was saying that it is always a good thing that the ratio of capex to the total expenditure improving is a good thing because the quality of spending is actually improving. In terms of the stock market, though, the problem is that, when the interim budget capex was announced, the market started pricing in that capex spend into the stock prices. So, especially with regards to companies, the investment-linked companies, it could be the capital goods companies. What happened was that the stock market already started pricing in the capex spends into the stocks. into the railway stocks also. Railway stocks, again, a lot of them started going up because they started pricing in the capex spends. But since there is no change from the interim budget to the actual budget, we feel that a lot of growth has already been priced into these stocks. So it is not that capex spend is bad or it is not up to the level, but there is a feeling that a lot of it has already been priced into these stocks or the stocks that are expected to gain from capex spend. So the valuation is already factored in the interim budget numbers, and since it has maintained status quo, there could be a slight underperformance in these sectors, in these specific stocks, including railway stocks also. Right, so that is something that we need to keep in mind. It has nothing to do with the quality, it is to do with the valuations, basically. Again, there was, I think, a bit of pressure on the government, the budgetary allocations based on the coalition party requirements. So you could see a focus on two states mainly when the finance minister was talking about infrastructure, Andhra Pradesh and Bihar. You could see the focus of the infra spend. So again, if you want to play that, you can look at the companies that are mainly operating out of, let's say, Andhra Pradesh. You can look at the companies mainly operating out of Bihar, because you can see a lot of infra spends in Bihar. You can see, as per the budget proposal, if I'm not mistaken, you could see a lot of highway allocations, a lot of highways being built. So road developers that are active in Bihar, for example, or, you could see the historical order generation over there with regards to highway developers. You can see, you can maybe play out that story over there. Even in Andhra Pradesh also, there is a lot of focus on building roads and building infra assets. So you can, if that is the case, maybe you can look at those companies that are active in Andhra Pradesh and Bihar when it comes to infrastructure. And of course, the capex, the spends were also in urban housing. Urban housing is also another focus area that the budget was mentioning. So we have a lot of stocks that are very active in the low-cost housing segment. So you can look at those stocks, because this is another segment that has been given good representation in the Senate. And of course, power, energy security, building small Bharat reactors, power would also be another area that the budget has focused on. But overall, when you look at the capex situation, it is definitely positive for cements, because irrespective of where the infra is happening or where the roads are being built, cement always plays a huge part in the infrastructure development. So a lot of cement companies, especially the big cement companies, they are this budget measure will have a positive impact on these on the cement sector. Of course, I was talking about the highway developers and also power companies. So overall infrastructure spend. So infra spend is again, it's nothing new. It is not going to be anything new in the coming years also, because that will be a focus for the government, the infrastructure development. So it is always good for us to keep track of infra companies, maybe identify a few companies that can benefit from any special focus that the government brings in. So that is with regards to the capex spends that the finance minister has proposed in the budget. Of course, the direct tax, I think Ms. Priya has touched upon the LTCG changes and the STCG taxations. It was a bit of a negative surprise for the market in the sense that it was not completely expected. Although we didn't mind a small increase in LTCG taxes, we also expected that maybe the STT, that is a securities transaction tax, might be done away with if the LTCG was increased. But of course, LTCG and STCG was increased. It might not have too much of an impact, a long-term impact on the stock markets, because if you remember, we did not have LTCG. LTCG tax was 0 at one point of time. And then it was changed to 10% in the sense exemption limit is there. So if your long-term capital gains was, below 1 lakh, there was no tax. Above 1 lakh, whatever is the amount would have been taxed at 10%. So that was also changed recently. Now it is again being tweaked in the sense that up to 1,25,000, would be exempt, and any amount above that would be taxed at 12.5%. So the change, of course, in the short term, yes, it could have a negative bearing on the stock markets. STCG to 15 to 20% would have a short-term impact, but overall, I don't think this is a game changer, especially with terms of LTCG. And two schools of thought always, in the sense, okay, why are other, let's say, financial assets being taxed at, let's say, 30% income, while only stocks or listed securities are being taxed at this low rate. Maybe considering the last couple of years, the performance of the stock market, the kind of returns that is generated, I think the government would have felt that yes, it is time to start, bringing up to the developed economy level. So that would have been the thinking on that. That is something that we'll need to keep expecting in the future also, because even the finance minister's commentary after the budget also alluded to this fact that, this is not the last time they will be looking at the LTCG. So we can keep expecting a few tweaks here and there with regards to the capital gains taxation. Property sale also, the 20% with indexation has been brought down to a uniform 12.5% long taxation. Now, that is, in a way, when you look at it, it is negative for realty companies, for these real estate developers, if you look at it, because the indexation benefit was always a good thing. But we need to keep in mind, we've not worked out the entire math behind this, the long-term capital gains being brought down to 12.5%. But the basic understanding is that if you've purchased a property recently, in the sense it is not too old, it is not an inheritance, or it is not being carried over from a generation or whatever, if it is recent, then this might be beneficial to you, because 20% has been brought down to 12.5%. It could be a negative impact only if the number of years that you've held the asset is too long. Then yes, it could be a negative, this change. If it is recent, then it might not have too much of, or in fact it might be beneficial for you as an investor or as a seller. So that is something that you'll have to look at on a case-to-case basis. But overall, yes, it is a bit negative for the real estate developers. The reduction in customs duty, a lot of sectors, the customs duty has been reduced for example, gold. Gold was a surprising thing, because the customs duty on gold has been reduced by 5 to 6%, if I'm not mistaken, which has actually started reflecting in the gold prices yesterday and today. If you look at it, it has started reducing. So that is actually positive for jewelers, right? The reduction in the customs duty, it is good, positive for the jewelers, and that is why you saw stocks like Titan and all that going up yesterday, because for them it is beneficial. But maybe from a gold financing company, from that point of view, it could be a bit negative, because again, the loan to value ratio would be impacted because of this. So the reduction in customs duty, it is good for jewelers, but it could have a negative impact on companies like gold financing companies. The customs duty reduction, it would be positive impact for battery manufacturers, textiles, aquaculture also. For example, shrimp feed, for example, the customs duty and all that has come down. So overall, when you look at it, the customs duty thing, yes, it has been marginally positive for many sectors, and that is something that you can look at. The one thing is that, surprising is that, of course, I was mentioning about the reduction in customs duty for gold. So there is a talk of how the government is now slowly shifting. Earlier it was focusing on the financial assets, about investing into the stock market, growing your financial assets. But there could be a subtle shift away from these financial assets into physical assets like gold also. So in terms of, the government coming out with, let's say, this reduction in customs duty for gold, there could be a subtle shift, in the sense that it is not just financial assets that are important, it should be physical assets also that need to be important. So that could be a subtle shift. Of course, the STT we saw on FNO, the Securities Transaction Tax on futures and options, has been increased. Personally, we at Geojit, we've always felt that FNO, in the current situation, it is becoming a very dangerous tool, especially in the hands of inexperienced investors. So any measure to, let's say, no, I wouldn't say to authorize or rationalize, but to have it in the right hands of, or in the right investors' hands, I think it's a good thing. And this is not the last that we are seeing with regards to FNO, because SEBI has made it extremely clear that they will be bringing out more measures. The government has also made it clear. So this is not the last that we are seeing anything with regards to FNO trading. We can expect more measures to come in, and in a way it is good, because we feel that especially in this day and age, when there are financial influencers, rampant on YouTube, saying on how easy it is to make profits by doing this and doing that, especially in the FNO stage, it is actually misleading a lot of investors into how easy it is to trade in FNO. So we can expect more measures on FNO, and provided FNO should not be curtailed, because it is also important. But I think investors should be more aware or authorized to do FNO trade. So that is something again that we are expecting. Of course, the income received on buyback is also to be taxed in the hands of the investor. So overall, when you look at it, again, these measures, I wouldn't say it would have a long-term impact. Of course, these are all sentimental or a kind of a short-term impact that will have on the stock markets. So these are the main measures that were there in the budget with regards to stock market. So when we talk about the sectors as a whole, we've talked about the infrastructure, the cement sectors, the FMCG sectors, and also sectors that are directly facing the consumer, especially in the rural economic setting. These sectors are also supposed to do well. So going forward, again, as I was mentioning, the budget, it will have a limited impact on the stock market. The budget has been good in the sense that, it was focusing on fiscal consolidation. The estimates that the government has come out with, these are all realistic. There are no much unrealistic estimates. The capex thrust is always good. A continuity on that is always good. The domestic consumption focus that the budget has brought out, it is good. So when you look at it, there has not been any negative impact or negative things regarding the capital market. The only thing that can impact the market is definitely the high valuations. So high valuations, of course, if it is being met by an equal measure from the government with regards to increasing the earnings or increasing the orders of particular companies, of course, these high valuations can be carried on. But at the moment, yes, the stock market, the valuations are a bit of a concern. We were expecting a little bit of correction. Even yesterday also it surprised in the sense during the budget speech, I think it went down, and then by the end of the day, the markets had recovered. Today, of course, there was a slight negativity, but we've not seen a meaningful correction in the market for some time. So any earnings downgrade, so the earnings season is going on, any earnings downgrade can have an impact on the market performance also. So going forward, our suggestion would be, of course, the market cap allocation would also be important, because large cap oriented, it should be large cap oriented, because mid and small cap, of course, there is only a little bit of room, let's say, for valuation. It would be safer to be in the large cap segment, and of course, accumulation would also be a very good idea right now. Instead of investing everything in one go, accumulation would be a good idea. Momentum stocks had their time, of course, because the market was doing well. Momentum stocks were all the rage. It was a good rage, but right now I think it would be good to focus on quality rather than momentum. And as per our fundamental research team, the base case target for Nifty is, of course, in December 2024 is 24,600, which does not give much room for leeway. But then, of course, in the short term, there could be a bit of underperformance. But at the end of the year, we see the Nifty base case scenario at 24,600. Of course, the plus would be 26, the minus would be 22, but base case scenario is 24,600. And this is purely driven by, of course, the GDP expectations, the FY25 GDP expectations, on the hope that there would be more foreign investor participation also in the markets, which could help bolster the markets. Right. So with that, I come to the end of my presentation. Any questions? I think we can take it up later. So thank you very much, guys. Thank you for the opportunity. Yes.
Thank you, Sri Sony Mathews, Senior Market Strategy, Geojit Financial Service Limited, for a wonderful presentation on the market analysis and on the very useful tips. I know that participants will take note of the same. Now we are moving to the last speaker of today's session. That's Sri Regit Tom Anthony, Managing Partner,